You've got it. The brilliant idea, the plan, everything's ready to go. But now you're staring down one of the first, and honestly, one of the biggest decisions you'll make as an entrepreneur. How are you going to structure this thing? So let's get right into it. Are you going to be a sole proprietor where legally you and your business are the exact same thing? Or do you create a corporation, a totally separate legal entity? This choice is a big deal. It's going to affect your taxes, your personal liability, and pretty much the whole future of your company. Okay, to really get our heads around this, we first have to talk about a core idea in Canadian tax law. It's called tax integration, and in a perfect world, this rule is actually designed to make your decision, at least from a tax perspective, a non-issue. So, what is tax integration? Well, you can think of it as the government's attempt to make things fair. The basic idea is that whether you earn your business profits directly or through a corporation, the grand total of tax you pay on that money should end up being exactly the same. Look at it like this. There are two paths. As a sole proprietor, it's pretty simple. The business makes money, and that money flows straight to you. You just pay personal tax on it. But with a corporation, it's a two-step process. First, the corporation pays tax on its profits, and then, when you get paid a dividend, you pay personal tax on that. The whole theory of integration says that the total tax from both of those paths should be identical. But you know how it is. That's the theory. In the real world, here in Canada, the system doesn't get it perfectly right. I mean, it gets incredibly close, but there's this tiny little gap. And understanding that gap is one of the keys to making a really smart decision. But hold on, before we dive into all the numbers, it is absolutely crucial to remember that this isn't just a tax decision. There are huge, practical, strategic reasons to go one way or the other that have literally nothing to do with your final tax bill. So why would you even incorporate in the first place? Well, the number one reason, the big one, is limited liability. It puts a legal wall between your business debts and your personal assets. But you also get some really powerful tools, like being able to defer taxes, opportunities to split income with your family, and access to that super valuable lifetime capital gains exemption if you ever sell. Plus, you get more flexibility in how you actually pay yourself. On the flip side, though, staying a sole proprietor has its perks. If your business loses money in the early days, which happens, you can use those losses to lower your other personal income, something a corporation can't do. Some deductions, like for charitable donations, are actually better on the personal side. And of course, you can't forget the costs. A corporation means lawyer fees, annual fees, and bigger accounting bills. It all adds up. Okay, so we've weighed the pros and cons, but what about that tax integration theory? How does it actually hold up when the rubber hits the road? Let's run the numbers and find out. So let's just imagine a business owner. Let's say their company's operations brought in $115,000, and on top of that, they got $133,000 in dividends from some investments. We're going to calculate the total tax they'd pay on all of that income, first as a sole proprietor, and then as a corporation. And here we go. After all the spreadsheets and calculations are done, here's the bottom line. As a sole proprietor, the total tax bill comes out to $11,443. And through a corporation, the combined tax bill is $11,366. I mean, just look at those numbers. They are astonishingly close. The difference, the grand total difference between these two options is just $77. That's it. On over $100,000 in taxes, the difference is basically a rounding error. So yeah, the theory of tax integration, it works almost perfectly. But almost isn't perfect, right? So where in the world does that tiny difference come from? Right, that $77 difference, it is not a random accident. It's actually the result of this precise mathematical tug-of-war that's happening deep inside the tax code. So let's pull back the curtain and see exactly what's going on here. And that's the key question, isn't it? If the whole goal is perfect balance, why would you build a system that's just slightly off? Well, the answer is that there are two key parts of the tax code that are just a little out of sync with each other. So what we have are these two competing forces. On one hand, the corporate tax rate is actually a little lower than it should be for perfect integration. That creates a small tax advantage for the corporation. But then, on the other hand, the tax credit you get for those dividends is also a bit lower than it should be, which claws back almost that entire advantage when the money finally gets paid out to you. It really is like a tug of war. One part of the system pulls just a little bit in favor of the corporation, while another part pulls right back in the other direction. They almost perfectly cancel each other out, and what's left in the middle is just that tiny, tiny $77 difference. So, after all of that, what's the big takeaway here? We've looked at the theory, we've looked at the practical stuff, we've even done the math. What's the most important thing for you to remember when you're making this decision for your own business? Here's what it all boils down to. Don't get lost in the weeds chasing a tiny tax saving. The system is designed to be almost perfectly balanced for a reason. Your decision should really be driven by the bigger picture. Is limited liability essential to protect your family and your personal assets? Could your business really use powerful strategies like tax deferral or income splitting? And are those benefits worth the extra cost and the extra paperwork? Those are the questions that truly matter. Ultimately, the tax system is set up to let you make the best choice for your business based on things like strategy, liability, and cost, not to try and trick you into a certain path for tax reasons. So now that you know how it all works, you're ready to ask the right questions and pick the best structure to bring your big idea to life.